Dallas, Texas. I'm Allison LaForgia, managing editor of HousingWire's content studio, and today I am sitting down with Daren Blomquist, the VP of Market Economics at Auction.com. Daren, thank you for joining me.
Good to be here. Thanks for having me.
So let's set the stage with what you're seeing in foreclosure auction data right now that most surprised you, and maybe even a little bit of what the industry should be paying attention to.
Yeah, I think that's a good question because I think there is actually some news here. The last couple of years, really the last 5 years, foreclosure volume has been pretty low. And in the pandemic, it was almost nothing. We saw a little uptick in 2022, but then it's kind of been flat since then. And in fact, I would say in 24 and early 25, we were seeing an unexpectedly low level of foreclosure volume. But what we saw at the end of 25 and into this year now are some pretty substantial percentage-wise increases in foreclosure auction volume, and they are also the bank-owned auction volume that we do. It's not, we're still, I always have to say this for people like Logan and others, that we're still well below the pre-pandemic level. So we're at about 40% below pre-pandemic levels. But in the fourth quarter of 2025, we saw a 48% year-over-year increase in foreclosure auction volume. So volume is coming up. It's still not crisis levels, but I think what mortgage servicers may be missing there is that there's been a shift in the market, and it's not a crisis, but it's something that they need to adjust to, and they could see their loss severity rates go up on these defaulted loans if they're not paying attention to this trend and really pricing their properties a little bit different at auction. It parallels the retail market a little bit, where it's become more of a buyer's market at foreclosure auction and less of a seller's market. So those sellers, who are the servicers, need to recognize that and adjust pricing and adjust their strategies to make sure that they're continuing to mitigate their loss severity.
Now, I want to talk a little bit about who's buying at foreclosure auctions, because I think there are some misconceptions around what that actually looks like.
Yeah.
And I want to talk about why that matters.
Yeah, I'll start with why that matters. I think it matters because I think there's a perception out there, and I'll get into the misperceptions exactly, that the folks buying at foreclosure auction are part of the problem when it comes to housing supply and housing affordability. And so if that's viewed as a problem, and I would argue that they're actually part of the solution instead of the problem. And so if policymakers and others come at it, well, these people are a problem, we need to do something to correct this problem, I actually would argue that that's going to backfire and contribute to worse housing affordability and worse housing supply. So the misconceptions are, first of all, only investors are buying at auction. We actually see according to our surveys as well as our own data, about 15 to 20% of our buyers are owner-occupants, and which doesn't sound like a lot, but when you're talking about an all-cash auction, no interior inspection, pretty highly distressed properties, it's actually somewhat surprising to me to see that 20% of our buyers are owner-occupants. So that's number one. Some of these properties are actually going directly to owner-occupants. Number two misconception is that the buyers are these large institutional investors, whatever that means exactly.
The problems that we hear
Yes.
about in the news.
And I would definitely argue our data shows it's not the case. Maybe 10 years ago, 15 years ago, there were some of these big Wall Street firms buying up properties at auction. That's not the case anymore. I was looking at our data, 99% of our buyers bought fewer than 10 properties in 2025. So, and 80% bought two or fewer properties, one or two properties. So these are not big institutional investors. The median distance between the properties they buy and where they live is 17 miles. And, so we call them local community developers. They live where they're buying. In talking to them, they really care about the communities that they're buying and the success of those communities. And they're buying in relatively low volumes of properties.
So let's dig a little bit more into what the dominance of those small local buyers at auction means for the actual communities.
Yeah, they're having a positive impact on the communities, and I think it's a measurable positive impact. If we look at homeownership rates as one, and there's this belief, too, that at auction, most of these people are buying the properties, holding them as rentals, building their rental empire. And there's certainly some of that going on, but 55% of our buyers say their main strategy is to renovate the property and resell it specifically to owner occupants. And we don't just believe our buyers, we look at the data and say, when a property sells on our platform, what happens to it? And about over 60% of the properties resell, so they're reselling back in the market. And of those resales, 79% are going to owner occupants. So it's a pretty high ownership rate. That's one of the things. They're adding value to these properties through renovation. But they're doing it pretty efficiently. They're taking about 6 to 9 months on average to renovate the properties, get them back into productive housing supply. So the other thing we see, the objection is that these folks are renovating the properties, maybe gentrifying communities, pushing out the local buyers. What we see is actually these homes, once they're renovated, are still very affordable. The average sale price over the last 10 years of a renovated foreclosure that was originally purchased on auction.com is around $237,000. That's about 32% below the average sale price of all properties over that same time frame. And then if you look in underserved, a high percentage of our properties are in what's known as underserved neighborhoods, which are either low income or minority neighborhoods. And in those neighborhoods, the average price is around $202,000. And in opportunity zones where our properties are sold, the average price is $185,000. So these are still on the affordable side of the housing spectrum. And on top of that, our buyers, so they're helping home ownership rates, they're improving the values of the homes, but keeping them still affordable. And then they're adding jobs to the community as well.
So you talked in several of your answers at this point about the opportunity for owner occupants. What realistically can be done to increase access for owner occupants to foreclosed homes at auction?
And I think there's some limited things that can be done, but at the end of the day, some of these properties are not good fits for owner occupants, at least most owner occupants, because they're highly distressed properties. You're buying them sight unseen with no interior inspection, so you're having to buy with cash. And so that and about half of them are occupied. And so that may mean that as an owner occupant buying the property, you're going to have to take care of the current occupant of that property, which a lot of owner occupants are not really equipped to do. So that's kind of the caveat, is a lot of these local community developers who are buying them are a great bridge from taking that property from distress to productive housing supply. But getting to your actual question, the owner occupants, I think one of the things you can do is, first of all, not prolong the foreclosure process that we've seen during COVID. The foreclosure process was very elongated, and so then you end up with more highly distressed houses and less supply. You're holding back supply from the market, and I think that's one thing. Another thing that can be done is just a very transparent auction marketplace, which that's kind of our mission, is to bring transparency and innovation to the foreclosure auction, which in the past was just the domain of a few people who knew about it. We called it collusion corner. If you went to these foreclosure auctions, there's just a group of guys in cargo shorts, maybe colluding with each other to buy these properties. We bring in transparency to it, and innovation means it's more inclusive. It brings more buyers in, including these owner-occupant buyers. I was just talking to one who is an owner-occupant, bought in Chattanooga, Tennessee, and she went there. She was intimidated. She thought she would be intimidated, but once she saw our staff there, they were willing to answer her questions, and she ended up winning the bid, and everybody clapped for her. So it was kind of that. That's another way, is transparency in the actual auction environment. And then the third thing is possibly looking at first look auctions, where you have a limited period, exclusive period for just first-time homeowners and maybe some other folks who qualify to buy the property. The previous administration tried that. This Trump administration, actually one of the first things they did is they scrapped the first look, but now they're talking about it again. I think there is some lift from those first look auctions, but you have to be a little careful with them, because that can turn into abuse as well, in my view, because you're just limiting the buyer pool for those properties.
So You've mentioned auction.com's data, and I want to spend a little bit of time talking about the trends that you're seeing in the data that you have access to, specifically around the foreclosure market's role in the overall market.
Yeah, I think I'm not sure if this answers the question exactly, but I want to say this. I think that foreclosures in the scope of the housing ecosystem, they're the wolves of the housing ecosystem. So if you think about Yellowstone National Park, once they reintroduced wolves into it, they were kind of
Critically important.
they were a very important part of that ecosystem. They actually changed the way, once they reintroduced wolves, it changed the balance of life and also even changed the geography to a certain extent. And so I take that analogy, maybe it's taking it too far, but I see foreclosures as you don't want a lot of foreclosures for sure in a housing market. That's what we saw in 2008 and following. But a certain level of foreclosures is necessary in a market that relies so heavily on real estate financing. You have to have that outlet to take distressed properties and recycle them back into the market. And that's what I see foreclosures doing. So I think when we see this rise in foreclosure volume, I'm not alarmed by it because we're still at very low levels. And I actually think it's bringing balance and health to the housing market by taking these properties. There's over 50% of our bank-owned auctions are vacant properties, so they're just sitting there, not doing anything for the housing market. And so returning that as productive supply to the housing market, I think, is very important.
I have to agree with you, and I love the analogy. I think
Okay,
the
good.
analogies.
I didn't know if it was going to fall flat.
I think the analogy is fantastic. So my follow-up to that is, what trends should industry leaders really be paying attention to in order to anticipate any shifts that we might see this year?
Yeah, I think it's the same thing for the retail market as for the distressed auction market. It's mortgage rates and housing supply. Those are the two metrics, I think, to look at from the point of view of servicers and others in the industry. If we see mortgage rates flatten or even go down a little bit this year, I think that'll bring more demand at the foreclosure auctions. We've seen a little bit of weakness at demand. They're mostly because of a pricing mismatch. And so mortgage rates is one, and then housing supply. Our buyers are very sensitive to the retail market housing supply, because they're selling back into that market. So once they buy a property, if it's taking them, instead of 6 months, it's taking them 12 months to get that property sold, they're going to be able to buy less at foreclosure auction. So in markets where, like the Southeast and Sunbelt, where we see supply coming up, our buyers are pulling back a little bit because they don't have the capacity and it's taking them longer to return those properties to the market.
So when you look ahead, where do you see the greatest opportunity for the foreclosure markets to support housing supply and affordability?
Yeah, I think so. I think that more of what I've talked about, more transparency at foreclosure auction is great, and that's produced better outcomes for servicers in terms of lower loss severity. It's produced better outcomes even for the distressed homeowners who are losing their homes. They're walking away sometimes with equity because the price at auction has gone above the total debt that's owed on the property. But I would actually say that the biggest opportunity that we're looking at is prior to foreclosure. Distressed homeowners who are facing foreclosure, many times they still have equity in their homes. There's an opportunity for them to sell that home, avoid foreclosure, and walk away with equity in a sale that's not a forced sale like a foreclosure sale, but a sale that they control. And so I think we call it pre-foreclosure sales. I think that's the opportunity. We have a program now called Smart Sale, where individual homeowners can come and post their properties for sale on auction.com. And we're starting to see more volume come there. But I think that's an opportunity for the industry to, prior even to foreclosure, to address things and make, at the end of the day, that will help lower foreclosure volume, which is, I think, a good thing for the market, and take care of that distress earlier in the process rather than waiting for that forced foreclosure sale.
Well, Daren, thank you so much for joining me today and for walking me through what we should be paying attention to, what the auction.com data is showing us, giving us a little myth busting talking us through misconceptions about what distressed sales actually look like, what those actual people who are buying them look like. So I appreciate you giving me time today, and we'll hear more from you soon.
Thank you so much.